The U.S. housing market didn't slow down. It hit a wall. Overnight, a 25% tariff slammed into Canadian lumber, and the shockwave ripped through the continent. In hours, America's biggest timber giant lost half its quarterly profit. Construction sites went silent. Home prices spiked before a single nail was hammered. And while Washington celebrated the move as a win for U.S. mills, Ottawa was already reaching for a trillion-dollar weapon that could turn the entire fight on its head. And it's one Washington can't afford to ignore. It began in early 2025, when the Trump administration reignited a decades-old trade war by layering a steep 25% tariff on top of existing duties for Canadian softwood lumber. Some shipments now face nearly 40% in combined penalties. The White House framed it as a defense of domestic industry. Canada saw it as economic aggression, and the move was no one-off. Other Canadian exports, including select energy products, were hit with a 10% tariff. By late July, Washington turned the screws tighter. The U.S. Commerce Department finalized a new anti-dumping rate of 20.56%, giving Ottawa until August 1st to cut a deal. Commerce Secretary Howard Lutnick said there would be no extensions, arguing Canada had years to fix the imbalance. Domestic producers like the U.S. Lumber Coalition cheered. They'd long claimed Canadian provinces let mills harvest timber on public land at below-market rates, undercutting American sawmills, and driving closures in logging towns from Oregon to Maine. Ottawa countered that the U.S. was dressing up protectionism as fairness. Yet behind the rhetoric, the Canadian government was considering something it hadn't touched in decades: export quotas. Limiting shipments to the U.S. would be politically risky, but the depth of the American escalation forced it onto the table. The corporate hit was immediate. Weyerhaeuser's second quarter 2025 net earnings fell from $173 million to $87 million, despite revenues just above $1.9 billion. Management warned the third quarter could come in another $60 million lower. The culprits: a housing slowdown as high interest rates froze new construction, oversupply in some lumber markets that kept prices weak, and rising input costs as tariffs injected uncertainty into supply chains. Instead of retreating, Weyerhaeuser doubled down, buying more timber acreage, expanding high-margin engineered wood lines, and approving a $100 million stock buyback to signal investor confidence. Yet, its fortunes were chained to a housing sector facing its own pincer-squeeze mortgage rates at their highest in over a decade, and material costs climbing in unpredictable surges. By May, new single-family home sales saw their steepest drop in nearly 3 years. Builders faced framing lumber prices that could swing thousands of dollars per project in just a few weeks. Industry estimates warned the tariffs could add up to $14,000 to the cost of a typical new home by 2027. The National Association of Home Builders called it a direct threat to affordability. The U.S. Lumber Coalition countered that short-term pain was worth rebuilding domestic capacity. Neither position was unassailable. The former underestimated the politics of protecting industry, while the latter underestimated the economic drag of constricting supply in a high-interest rate market. Canada wasn't bluffing about leverage. International Trade Minister Dominic LeBlanc pointed out that Canadian investors hold roughly $1 trillion in U.S. assets, growing by $100 billion annually. It was a reminder that economic interdependence cuts both ways. Prime Minister Mark Carney rejected the August 1st deadline, stating Canada would not accept a bad deal under pressure. His government pursued two tracks: exploring export limits as a bargaining chip and accelerating market diversification. That diversification moved fast. In just 1 year, Canada's share of softwood lumber exports going to the U.S. dropped from 78% to 68%. Europe and Asia picked up the slack, though shipping across oceans meant higher transport costs and adapting to different grading standards. The pivot showed Ottawa's willingness to absorb short-term pain to avoid long-term dependence. One development gaining quiet attention in trade circles is how the tariff fight is drawing in third countries. Japan and South Korea, both major importers of Canadian softwood, have signaled interest in locking in long-term supply agreements at discounted rates, taking advantage of Canada's urgency to diversify. European buyers, particularly in Germany and the Netherlands, are negotiating contracts measured in decades. effectively reserving supply that once went almost entirely to the US. This shift isn't just about lumber, it's about bargaining power. When Canada's long-term commitments to Asia and Europe mature, even a future US policy reversal may not restore previous volumes. Washington could find itself competing for access to Canadian timber it once assumed was guaranteed. Simultaneously, currency fluctuations are amplifying the divide. The Canadian dollar's softness against the US dollar is making Canadian lumber more attractive to global buyers, even with longer shipping distances. That currency tailwind is narrowing the price gap with US suppliers in markets far beyond North America. For US policymakers, the realization may come too late. The tariff that was meant to secure supply for American builders could end up pushing Canada's most valuable export relationships permanently offshore. In Washington, tariffs were paired with a plan to boost U.S. logging by 25% on federal lands. The administration pitched it as a supply fix. Forestry economists were blunt. Even fully executed, the increase might lift total U.S. supply by less than 1%. Federal timber is limited, much of it inaccessible without costly roads or unsuitable for construction-grade use. Legal challenges from environmental groups were inevitable, meaning years before any extra wood reached the market. Some U.S. mills, especially in the South, didn't wait for policy outcomes. They invested in automation to squeeze more product from each log, hoping to seize market share if Canadian imports stayed expensive. For towns that had seen mills close over the past 2 decades, it was a cautious revival. But the housing sector's immediate needs were measured in months, not years. Canadian lumber companies took another route, buying U.S. mills outright. Firms like West Fraser and Canfor expanded operations in Georgia, Alabama, and South Carolina. By cutting wood domestically, they avoided tariffs entirely. U.S. industry groups largely welcomed the jobs and capital. Though some mill owners worried about intensified competition from well-capitalized Canadian firms now operating inside the tariff wall. Midway through the summer, both countries had reshaped their strategies, but not the underlying dispute. The last softwood lumber agreement expired in 2015, and without a replacement, there was just no mechanism to stop escalation. Trade analysts floated potential solutions, like multi-year quota deals under the USMCA framework, joint forestry investment agreements, or harmonized sustainability standards. Each would require political concessions neither side had yet been willing to make. Let's pause here, because this isn't just a tariff fight anymore. It's a race. Canada is racing to replace U.S. market share before the housing slowdown becomes permanent. The U.S. is racing to ramp domestic production before builders cancel projects en masse. Both are moving faster than they can measure the consequences. If history is a guide, the real danger is that the damage will harden before any deal is struck. Mills that close rarely reopen. Export routes reconfigured for Asia or Europe often stay there, and buyers priced out of homeownership may never return to the market. By August, the stalemate had become a test of political will. Washington was betting that sustained tariffs would force Ottawa to concede. Ottawa was betting that market diversification and selective leverage could withstand the pressure. Both strategies risked misjudging how quickly economic pain could calcify into structural loss. Beyond the economics, the dispute was reshaping political narratives. In Washington, it was framed as standing up for American workers. In Ottawa, it became a matter of defending national sovereignty and trade. In both capitals, leaders faced domestic constituencies unwilling to accept a climb down. Meanwhile, the consequences were multiplying. U.S. housing affordability continued to deteriorate. Canadian forestry towns watched shipments fall. Global lumber flows shifted in ways that may be irreversible. The softwood lumber dispute had become a symbol of how integrated economies can still fracture under the weight of political agendas, and how once stable trade relationships can be undone in months. Some experts suggested that resolution would require both countries to accept terms they once rejected outright. Maybe quotas Canada had resisted for decades, or tariff suspensions Washington had refused to consider. Others saw opportunity in reframing the fight entirely, focusing on joint climate and forestry goals that could justify a cooperative supply agreement. For now, neither side is blinking. The U.S. is holding the tariff line. Canada is spreading its exports and hinting at financial levers it could pull. Each is calculating that the other will reach the breaking point first. The outcome won't just decide who supplies 2x4s to American homebuilders. It will shape how the US and Canada handle every future economic conflict, from energy to agriculture to tech. In an era of weaponized trade policy, even the most familiar cross-border flows can turn into battlegrounds overnight. And as the summer heat bakes idle lumberyards and half-finished frames, one truth is becoming unavoidable. Once a market rewires itself under pressure, putting it back together can take far longer than anyone plans. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.